TD and CIBC, the latest banks to report earnings this week. What's the one to watch among all of the big banks? Let's go to Garnet Anderson on this, Vice President, Head of Portfolio Management, Tacita Capital. Thanks for coming in.
Thank you for having me.
Was there a trend, first of all, in the bank earnings that you noticed?
Well, all told, they came out relatively positive. Really only National missed by a hair. Driving it, if you think of it, steepening yield curve, positive. Markets up, so good for asset management. Actually, loan creation did not crater despite all the USMCA hoopla, though we can talk about that a little bit later, 2026. So that remained relatively strong. And then when you take a look at PLCs or loan provisions, virtually all of them scaled them back. They looked and assessed the marketplace and said, look, the non-performing loans are not as bad as we thought, and or the performing loans, given what we think are in the economic tea leaves today versus 3 months ago, things seem to be a little bit more settled down. They were able to pare that back, all the while helping their earnings per share.
That being said, you like TD as a stock pick. TD got a little bit better today after reporting their results.
Yeah, got a thud.
So why do you like TD at this point?
Well, I think this is a longer term play. And the reason we say that is the Canadian operations did well. They still have the U.S. operation. It's like gum on the bottom of their feet. So when you read through the call transcripts and you go through the financials, they come up right up front, they address it, but they still have restructuring charges. They're still selling off the loan book, taking losses on that. They're contained in terms of how big their business can be down there. It's a multi-year process on the remediation front to get through it. So really the thought coming in was, first of all, TD had been hot performer coming into the season. And often it actually takes a little step back, regardless of it positive surprises or negative surprises. But pushing through there, it was along the lines of kind of wait for a step back, because there probably would be a little bit of euphoria, did not transcend today. Because folks will have to start to wait to 2026 to start to see over the horizon in 2027. So I think they're doing a bunch of the right things, but it's going to take time. And then there's a little disappointment. I mean, you have the charge related to paring back their staff. They are making investments in technology, which have to pay off over time, but not at the outset. So perhaps not so surprising, he took a step back. In fact, the premise coming in was wait till it gets to kind of the low 90s. Over the past 10 years, it's had 5-10% or more step backs. Okay. You go back to COVID, that was big on, taking 35% off the table. So there's no rush to buy it, regardless of what happened today. A quarter's a quarter. But waiting for an opportunity. For those that own it already, you still get a decent dividend and have to give them credit, like many of the other banks. They're oligopolies, they generate cash, they increase their dividend yield. I mean, you kind of look at the CAGR, compound annual growth, over the past 10 years, about 7%. So you go back 10 years ago, their dividend was, 51 cents a quarter. Now it's $1.05 a quarter. So if you're a long, patient investor, you wouldn't be running away. If you're bringing new capital to it, you might wait for the next pullback.
Okay, let's talk about NVIDIA as well, because EAT has also been brought down by its most recent earnings report, and some say that's because even though they had 56% increase, I think, in profit or was it profit, and still people are kind of deciding that they aren't going to give it any love. China is a concern for them and what it can do in China as far as sales go. But Washington changes its mind daily on how they're going to allow that to happen. So what is your take on NVIDIA moving forward?
Well, I won't quite say it's priced for perfection. And in all honesty, it would not be in our U.S. model, given its current valuation level. We just can't get over that hump. But having said that, it is a trendsetter. It controls that marketplace. It's shown itself to be pretty politically mobile, if you will, dealing between the two governments, China and Trump and co.
Yes.
Very, very difficult to do. Struck a deal. I mean, the revenue share on each 20 units going over. Lovers and haters of that. I mean, really, why is the U.S. government getting into there?
Export tariff.
Yes,
right?
Yes, exactly. And then you've got China kind of responding back and saying, well, wait a sec, we're going to buy your chips and we're putting money into the treasury?
Yeah.
Explain that to me again a little bit. So I think that is a little bit of a challenge. Now they're coming out and really with their Blackwell Can they scale it back as they've done in the past and send over a revised, lower-powered version over there? I mean, I think if we're sitting here in 3 years and 5 years, I think you're taking a look at that and saying, look, this is a leader in a growing area. That's going to be a good stock. But I think the thrills and spills along the way will be seismic. It's the nature of a massive capital build-out like that you're going to get bouts of overcapacity, overexuberance, and then a single quarterly report, for example, could pull back.
Yeah, people are very sensitive about the
Exactly.
their NVIDIA investment.
Well, when you've got those kind of multiples,
Yeah.
that's the nature of the game.
Got it. Okay, let's get to one of your residential REITs that you like because it's something you're liking right now. Which one is on your mind?
Well, when you take a look at residential, they are beaten up right now. They're off about 25% from their highs. Now, just a quick step back there. At their highs, they were probably about 10% overvalued. It was a little bit priced for perfection. So when we take a look, Killam is about 20% discount to its NAV. It's off about 25% from its high. It's got a decent yield. Its profile of its apartments is kind of spread a lot of East Coast. They do have some out in Alberta. So the markets that they're in are not as subject to rent controls as, for example, maybe CAP or CAR.UN would be. And when you take a look at their same property NOI or net operating income growth, you take a look at their lease renewals. And there's really two types. There's lease renewals people click on. Mm-hmm. Those are clicking around 3-4% year to year. But when somebody moves from one apartment to the other apartment, usually you get, as a landlord, a higher clip up. Now you often have to paint the walls and what have you. And they're not really subject as much, it seems, to having to pay out incentives given the market they're in. Or again, we contrast that to CAR.UN or Canadian Apartment REIT. They still have some residual of incentives having to get people in. Both are sitting there with high occupancy rates. Sorry, let me reiterate, high occupancy rates. So good, solid long term. The yields aren't super high, particularly for REITs, but they're palatable. And this could be a case of waiting it out. But ultimately, at some point, the immigration story may change.
Yeah.
Probably more that than, per se, interest rates coming down and that being the coup de grace in terms of moving those REITs ahead.
Got it. All right. Do have to leave it there. Garnet Anderson, appreciate you coming in. Garnet's the Vice President, Head of Portfolio Management, Tacita Capital.